Awesome. Well, thank you all very much for making the time to come on and throw questions. I hope the answers are going to be valuable and insightful. One thing I can promise you is that I will just be totally blunt, candid, and honest. I think there's enough opaqueness in this whole industry, which makes it quite difficult. So yeah, I want to break that down. I can see some familiar names and familiar faces as well, which is good. So, but for those of you I haven't met before, my name's Sam Marchant. I've been a VC, early stage VC investor for the last kind of 4.5 years now. Before that, I was a founder of an FMCG business. So we produce low sugar cereal bars. That was a kind of spin out at university, something that happened by pure chance, was good fun. We took that business kind of all the way through and had a good outcome with that in 2022. And for those of you who I have met before, or maybe follow me on LinkedIn, I recently actually kind of left the VC side. To be honest with you, I feel like there's a big opportunity right now from a founder perspective, and I wanted to go back onto the founder side of the table. So I won't talk about what I'm doing because that's all lined up for September. But yeah, excited to be back on your side of the table. So hopefully I can share all the dirty dark secrets of VC or founder life, whatever you want. So please ask any question. Don't feel that your question is too dumb. If you're thinking it, someone else is probably thinking it as well. So yeah, no question is too stupid. Fire them all away.
Yeah, and just to clarify on that point, there are a group of founders fundraising for the first time on this call, and there's also a group of founders who have maybe raised before, or got some friends and family money or pre-seed money that are raising for the second time. So all questions are absolutely welcome. We do have a few in the chat that we can start off with, but if you can ask it live, please do raise your hand and ask live so that you're not just hearing mine or Sam's voices for the whole time. I'm going to start with a question that was sent in by a founder who couldn't attend in person. So if a partner leaves their VC firm, do they carry any conflict of interest with them if they then go on to work at a new fund? So if they've invested in a particular startup and your startup is in the same space or is competitive to that startup, but then you go somewhere else, does it stay with the fund or does it stay with the person who was managing that deal?
Yeah, it's an interesting question. So I think the way to unravel this is to think about partner incentivization and remuneration. So partners are typically very heavily tied in via carry to a fund. If a partner, in the same way, if a founder leaves a startup, if a partner leaves a firm and they're deemed a good leaver, they will likely keep the carry that they have in that fund if it's vested. So again, same as like founder equity, there's always carry vesting on funds, or there have been at all of the funds I've been at and all the friends I have. So if a partner leaves, the only conflict of interest would be that they probably have carry in companies that they have invested in that fund, which means that if they're going to go to a new firm and invest in a direct competitor, I mean, you could argue that they probably don't have any more information. They don't have direct exposure to the original investment, but they do have upside. So they haven't, they're kind of incentivized to continue to try and support that business, I guess, from afar. So I would say there's probably not a direct conflict of interest, but it depends on whether or not the partner left in like a good leaver or bad leaver way. So, which is quite a boring legal answer to the question, but unfortunately, that's the way it is.
And probably quite difficult for the founder to work out how the partner may or may not have left because it's not necessarily going to be public information.
Yeah, no. Obviously, you're going to find the great stories on TechCrunch and what have you. No one's ever going to say bad things. I would just look at the tenure of the partner and say, okay, they were there for 10 years, 5 years, whatever it may be. The likelihood of them having carry when that investment was made is probably pretty high. So therefore, that's where the conflict will be. I would think that any good professional investor would make the conflict clear from the get-go and would say, just so you know, I have carry exposure to a direct competitor through a previous fund. Maybe it does stop them, maybe it doesn't stop them. If it was me, I would probably say, I would just make them aware and say, look, I'm not going to share anything from you, and I'm not going to share anything back to that other company. So we can kind of continue conversations from there. But that's me. That's personal view.
That actually leads to another question which has come up before, just in case anyone's thinking it, because sometimes founders don't know whether to pitch a fund if they've got a similar business in their portfolio already. So maybe not exactly directly competitive, but in a similar space, and they're worried about the fund maybe taking, you know, their IP and giving it to the portfolio or something. Any advice on that?
Yeah, it's hard. This one is hard because this comes down to just how the investor behaves. I can quite comfortably say here with full confidence that I have never ever shared a deck that I've received inbound to a portfolio founder or to another company. I'm sure there are VCs out there who can't do that, but probably would say that. You know, it really comes down to how those VCs want to behave and conduct themselves. I think that the more visible and the more integrated a VC is with the founder ecosystem, the harder it is to do that kind of shady behavior. Not that you would want to, in my opinion, anyway. So I think in terms of if you should go and pitch to that firm, I think it's about probably in your outreach saying, hey, look, I know you've invested in such and such. You know, we're operating in the same space, or we're servicing the same customers. Maybe we're doing it slightly differently, or, you know, we're using a different technology, or we're coming at it from a different geography. You know, it could be anything. Just make it very clear from the get-go. And again, personally, I've always made founders very aware that, you know, what you'll find often is that founders will share a one-liner, which is purposefully quite broad. Then you'll get the pitch deck. You'll go through the pitch deck and you go, oh shit, this is similar to, you know, a portfolio company of ours. And I'll say, hey, look, you know, you sent it to me on DocSend. You can see I viewed it. You can see I haven't sent it. All right, just to let you know, we have a portfolio company that's competitive, so we can't take the conversation further. And just personally, I'm always like, but I think you should go and speak to so-and-so VC, right? Because on most of the deals that we've done, there have been funds that either didn't get into the deal or couldn't get there at that certain stage. So it's always helpful to just point founders back to those funds, because if they're still looking at it, then, you know, I just think it's a good thing to do, the right thing to do.
Yeah. Thank you. Just for everyone, just in case you've updated the new version of Zoom and you don't know where to raise your hand, you need to go to the react button at the bottom of the screen, which now looks like a heart, and then you click the arrow up and you can raise your hand that way. I was struggling with the new Zoom earlier and Adam just mentioned it as well. So again, you can put your questions in the chat if you don't want to ask live. I'll go to these 3 hands that are raised now. It just says dib@wellents.me. So sorry if that's not your name, but do you want to take yourself off mute and ask your question?
Yeah, it is my name. It's not that common in UK, so I can imagine. Thank you, Purdy, for putting this together, and thank you.
Very good.
Thanks, Sam. Congratulations on joining this side. Is Sam still there?
Yeah. I'm still here, sorry.
It's still there. Okay. Yeah, I don't feel bad now that, given you're changing roles, not receiving any response from you after a few outreach.
Not bad.
So I'm building a B2B SaaS platform in the future of work. We MVP, we're working towards a paid pilot program with Amazon. So that means pre-revenue. Just a couple of thoughts. So questions for you is, how would you design first of all, would it be focused entirely on angels at this stage, or are there VCs that I should also target? That's number one question. And second question is there any top tips on cold outreach that you can give us? And within that, what are the minimum we should share rather than giving a lot of information?
Cool. Okay. So on the first question, just how much are you raising?
400K.
400K. All right. Have you used any of your SCIS already?
I haven't used it.
You haven't used it?
Bootstrapped
it. Cool. Okay. And the business is SCIS qualifying though?
Yes.
Yeah, cool. Okay. So look, I mean, it's such low-hanging fruit. That's what you should be using first. How would I put this without, I'm not going to name names, but there are SCIS funds out there that will take the full 250K amount, but they will be investing, 50, 60 deals, maybe even 70 deals a year. The support that you're going to get from those funds is rubbish. And because of the fund sizes, right? So you got to think about the way that VCs make money through management fees. SCIS funds tend to be much lower sizes, right? So they make smaller fees, which means that they often charge investment fees back to you. And that's basically just money taken directly out of the business to fund a VC. So for those reasons, I'm not a huge fan of these kind of SEIS focused funds. And look, I worked at Ascension when the SEIS fund there. I would say that genuinely they are the best in terms of how they operate and how they go about things. But that's because the founding team are all exited founders, so they've done it and they've been there. Which means that that I would use that as your fallback option. I would focus on angels to start with, right? And what I would do is I would probably give preference to the largest ticket sizes for SEIS allocation. And the reason for that is that the people who are often writing the largest check sizes are the ones who often have the largest tax bills. And if you can try and tie those two together, what you might find is if they're not familiar with SEIS, all of a sudden they go, okay, yeah, I will increase my check size because I understand how I can claim the relief back. So I think that's super important. So yeah, for a 400K round, I think it's probably probably an angel round or maybe a strategic, much smaller fund like maybe a plug and play ventures. Palmstorm, I think we're writing smaller checks as well at the moment. Conduit Capital. There are a wide range of like EIS funds out there that you can probably have a look at as well. And to give that some context, when I was at Salica in the early stage team, the smallest check we could write was 500K, and that's because it was coming from a 100 million pound fund, right? So that's just kind of I guess the minimum level that we're at. In terms of your second question, sorry, on cold outreach. Well, firstly, I'm sorry for not getting back to you. It's not a great advert here, is it? And I'm not going to cover myself. It's very rude of me, and I should get back. If I could get back to every single person who DMs on LinkedIn every day, I'd be very, very happy. Promise you. But unfortunately, I can't. That is. I'm going to use it as an example, I guess. Most VCs like that are pretty lazy. The best way to get into a VC, in my experience, is either through a portfolio founder or through a direct email. The LinkedIn messages, because everyone on the VC side is now using tools to automate their own outreach. They're using AI to craft these things, to craft messages to approach founders. It's an absolute mess, right? I won't show my inbox now live, but it's carnage, right? So if I was you, I would try and grab hold of an email and I would try and go through that way. I think you can craft much better emails than you can LinkedIn messages. And in terms of materials that you should share, you just want enough to get a call, right? That's all you want, is you want someone to be interested enough that they're going to get a call. I've always found, and this is just, people have short attention spans, people are inherently lazy. Make the email, boom, this is who I am, this is what we do, and then boom, this is the key traction, this is what we've done so far. So everything you said about AWS, the pilot that you're running, etc., put that in bullet points, bang, done, and then ship it. You could probably link a deck in there as well, but again, you might want to keep that super short. And one thing I would definitely do is make it easy for the VC to book a call in with you. So just stick your Calendly in there as well. It's one thing that I wish founders, when I was on the VC side, I wish founders did more, because otherwise you have to go back and say, okay, can I find this time or what have you? And trust me, it gets even worse when you get to partner level, because they then go, okay, here's our team EA, I'm going to loop them in, and it's just a slow process. You just want to convert straight away, like any sales opportunity, right? So yeah. Does that answer both questions then?
Yeah, I did. Thank you, Sam. Really appreciate it.
And I will go back on LinkedIn and respond to you. I promise.
Much appreciated. Job done. Thank you, guys.
Worth coming. Next up is Shuyu.
Hi, Sam.
There we go. Hey.
Yes, sorry. Just try to unmute myself. I follow you on LinkedIn. Thank you so much for all the amazing content you share there. Always learn a lot. Yeah, I think my first question is probably you've already touched upon a little bit. I want to ask, what is the most preferred channel from an investor, let's say VC or any other type of investors, to source their interested founders or deals? That's kind of my first question. You touched probably briefly. Is there anything on top of the portfolio founders or email outreach that you want to add on here?
Yeah, it's a really funny question. I'm not going to give you, I'm probably not going to give you the answer that like a silver bullet, you know, or a straight up answer. I think I'm just going to set some context, right? Which is that I'm seeing, or I was seeing more and more VC firms using, you know, AI scraping tools to ingest huge amounts of data on founders, people on LinkedIn, and then trying to put pieces together as to who might be an interesting founder. Does this create huge bias in the way that VC screen and well source and screen deals? Yeah, of course it does, right? And this is where I default back to the fact that most VCs are inherently lazy, and if things don't land in their lap and the decision is made for them, right, then it's very, very hard. The only other way outside of the portfolio founders or a kind of direct email that I can see working is through angel investors or angel syndicates. At Salica, we had a really interesting kind of angel, I guess, bubble that was around us. We had them all on Slack and we would chat with them, and they would share deals that they were interested in or founders that had reached out to them. And it's just that kind of network effect. I don't feel this answer is hugely helpful, because I can't say, oh yeah, there are three other ways of doing it. I'd say it's probably more just a word of caution. VCs, there are two things that drive real kind of VC interest. I think one is that other investors are doing it, right? Which is just that lazy kind of FOMO factor. And the second thing is, we think we found someone that no one else has found, right? And that kind of specialty factor, which makes it very, very difficult from this side, right? When you sit on the founder side of the table, but you just got to try and play that game and try and leverage that. One of the only other, I guess the only other thing I can add is that if you are already speaking to a VC, ask them who they like to invest with. Most VCs have their friends that they like to do deals with, or they will share deals with. When I was at Salica, had a list of people that I liked doing deals with and people that I didn't like doing deals with. So when I met founders who were like, oh, I think we're going to speak to so and so, I'd say, hey, look, I can intro to 2 or 3 angels that are going to take that, and you don't have to deal with that SEIS fund, and it's, yeah, I think it's just better for the cap table and better for everyone. So yeah, I don't know, does that answer the question? I don't feel like that's a super practical answer, but and I don't want to be too bleak.
Yeah, I mean, this is very helpful, because I think the types of point of contact you mentioned are a good starting point. Can I ask one more quick question?
Yeah, fire away.
Okay. So from your knowledge, do you know how many funds are currently actively deploying, investing in early stage companies in the UK?
In the UK, wow. No, I don't have a specific number off the top of my head. I know that there are a number of funds who are in fundraising mode. I can't think of any, and I probably wouldn't name drop anyway, but I genuinely can't think of any that are fundraising that don't have capital to deploy. There are funds that are in interesting, slightly precarious positions with the capital that they do have left to deploy and fundraising situations, but they're all still kind of active.
Okay.
And linked to that, I think there was a question earlier about the kind of market downturn right now, whether that impacts kind of VCs. The two are linked, but actually they're linked in a way of the LPs that fund VCs. If they don't have the level of liquidity they thought they did to make capital calls, then there's an issue. However, most of these LPs are allocating less than 5% of the entire portfolio that they manage to venture capital, much less than that. So it's very, very rare that that's actually an issue. But no, I can't think of any funds, like I can't think of any bad actors. If that was the root of the question, I can't think of anyone who's out there saying, oh yeah, we've got money when we don't have money.
Yeah, so like it's just kind of just a temperature check, as like there are many funds out there in the UK, just trying to understand how many of them are just kind of take meetings but not actually investing. But it seems like it's more positive than.
Yeah, so actually what I would do to answer that question is I would go, there's a thing called and I will plug it only because I know Purdy and M know Dan as well, so it's fine. There's a tool called ShipShape, and one of the things that I've been pushing Dan to build for ages on there is like a a time scale for a VC, so that as a founder, you know where the VC fund is in their deployment window. Because every VC makes a shout, oh, we've raised £100 million, and we're now 3 years away from that announcement. So you can see that they're kind of there. Thank you, Em. So, and I think Daniel has either released that or is going to release that data very soon. So you can see who actually has money and who's deploying and who's not. What I would say is that, we're coming into now the period where all of the tax efficient funds are looking and going, we haven't deployed much capital. The mid-July, I had 3 funds in the same week reach out and say, and they were all tax efficient funds, and say, hey, what are you looking at? We need to get money out for the close of summer. So yeah, there's still intent for sure.
Thank you. Adam.
Thanks, Freddie. Thanks, Margaret. Hi, Sam. Sam, I'm one of your inbox polluters, so I've just re-energized an old message from a year ago.
Oh man, I'm sorry. I was like, I've opened myself up here, haven't I? My bad. I'm really sorry, everyone.
I do it in jest. I literally expect no one to reply, and I'm always pleasantly surprised if anyone does. Thankfully, you've already answered half the question I think that I probably would have posed. I've been trying to busy reshape the question. So I think what I'm going to do is I'm going to ask you, now you've come back onto the other side, or at least pending, do you see your approach as being a bit more bespoke, a bit more maverick, outside of what I see as much more formula-based funding? So when we're advised, let's say, as startups, and I've been doing this for years, but I'm just talking generally, there's this kind of like methodology, do it this way, practice this, get your pitch deck into these particular slides. I mean, is there ever a case where you think, from your perspective, and are you going to do it, that being the anomaly is sometimes the standout approach, or not? Is it just these AI filtering tools are going to win and that's it?
It's a really, really interesting question, isn't it? And it ponders on, I can ponder on it in a number of ways, because so I think the way that we deploy and the way that we invest capital is going to change quite dramatically. I think we're going to come into a really bad period of returns, right? And I'm talking about this as if I'm a VC, and I'll explain why I do that in a sec. We're going to come into a period where there's, a lot of investments have been made. We already have 1,300 companies valued at over $1 billion, private companies valued at over $1 billion, right now in the world. How they return any level of liquidity back to investors that people are expecting, I have no idea. Which will mean that, underlying LPs go, well, we didn't get the returns we thought we were going to get. The managers are being paid really big fees comparatively to other asset classes that we can invest in. So why are we even bothering doing this? Maybe some of the more impact focused funds, they'll say, okay, well, we got returns, but we also did this impact, and that's fine. That's what we were looking for. But I think most people are not going to be happy with the performance. In terms of how you go about and how you go about fundraising, I think what I can see happening is founders going kind of full circle on VCs and venture capital in its entirety. And I think what will happen is hardware, and I guess when I think of traditional, 1970s, 80s VC, where they started investing in we're talking like proper tech, right? Those are the guys that will come out and win again. So the big names, your Sequoias, your Greylocks, your Kozlers, your Lightspeeds, etc. Those are the guys that will come and win. The funds that are focused on B2B SaaS, founders will not need those funds, right? Because one, they'll be building incredibly capital light OpEx, light businesses, mainly using AI. And secondly, they will not want or will not have the option to try and scale a business to then IPO it. It just won't be of interest to founders. Founders will want to build for 20 to 50 million pound exits with a bubbling PE and M&A market. That is just that's what I'm incredibly bullish on. And I saw that in June. I was in San Fran. I met a founder friend who I've known for a while. This is business number 4. He's bootstrapped 80 million of ARR. He owns just under 90% of it, the option pool, and then just him. And he was like, Sam, we've made a right mess of it. He said, now everyone at 80 million of ARR, he said, now everyone expects us to IPO. He said, I should have sold this thing when we hit 20 to 30 million of ARR, bang, off the bat and go. Because he was like, now the journey is just totally changed. And I think his mindset is the mindset that a lot of founders will take and will say, okay, I don't want to strap into this long-term journey. So in terms of being an anomaly, I think to start with, the founders who think like that will be called anomalies, and then all of a sudden everyone will go, oh, hold on, actually this makes quite a lot of sense. But I say that only for, you know, very kind of capital light businesses. For where it's hardware and deep tech, there's always going to need to be, you know, venture capital there. That will just change, and I think it will become far more selective for the funds, right, that are backing those entrepreneurs. So I don't know if that answers the question, but that is definitely a question that you want to sit with a beer and just ponder on, right?
Yeah, no, thank you for that answer. I think you also mentioned ShipShape, and in the back of my mind, we've got these kind of interesting modernized AI tools, scribing, and where we're able to collect up data, not necessarily interpret it very well as founders, because you guys are in a better position to understand how that data reflects on historical record keeping. But we're seeing this flashpoint information. Oh, look, you know, there's all these investors available. Here's what they're deploying. So I don't know how well schooled generally founders are to actually get hold of this information, really make use of it. And the flip side of that is, sooner or later, surely these funds, these VCs, even angels, are going to get smart to the fact that everybody's got their information now. It's going to become a bit like your LinkedIn, but for outreach. And I that scares me, because then if you're not an anomaly, you're just in the mix of hundreds of thousands of people that have had access to this information all of a sudden, and that seemed overbearing.
Yeah, I mean, and I think the way you talk about anomaly, I think about it immediately as someone who's just building a good business, right? You know, some of the best businesses and the ones that we've been most excited about, you know, you're knocking on the door of the founder for so long, or they say to you, yeah, we think we might want to raise, you know, and you look at the numbers and you go, this is a great business. Like, we would be so lucky to invest in this right now, like so lucky, you know. In terms of the tools, it scares me, because I heard a story, and I won't name names, of a fund that was using an AI tool to reach out to, so source founders and then reach out to them and then booking calls, right? Could do the whole flow. And I heard in a founders forum, I heard about, apparently someone turned up to a call and an associate had genuinely no idea who the company were, what they did, right? Like, didn't understand. They obviously knew the context of the call was to talk about funding and pitching. And apparently it was a disaster, right? And you just think that is just terrible, you know, for how this has become. Oh, it's a great sign. It's terrible, and it's a great sign of how this has just become a numbers game, and people don't know what first principles and core fundamentals are. And the ones who lose out the most are the founders, because founders spend so much time talking to VCs where they'd rather be building shit, you know? So that's something that I'm quite, now being back on this side of the fence. I mean, trust me, look, even changing your LinkedIn to building something new, the number of people who were like, hey, Sam, you know, would love to hear what you're building. And I'm like, come on, you know, you didn't want to go for a coffee when I was a VC. So yeah, anyway, there we are. Rant over, sorry. I told you it was going to be unfiltered. I said.
With the just based off Adam's question that he just asked, with the anomaly thing, did you use Salica, or do you know any other investors that use AI when decks are coming in to do like a first check to see whether it's worth them going to a first call, and therefore whether having, you know, your 11 slides, problem, solution, total addressable market in that order is actually better, or then trying to do something different and stand out, whether that would help you or hinder you if you're using AI to look through it?
Great question. I can confidently say we didn't. We spoke about it. We said, okay, should we be like, because we could summarize a deck into like a, you know, a short, sharp little email. And we said no. And they felt, the partners and as us as a team felt quite strongly that our job was to go through the decks, right, and to be in them. I would be confident in saying that, yeah, there are probably funds out there that are doing it. But they're probably the funds that are largely understaffed, under-resourced. You know, they're just using an AI tool to extract from the deck, kind of a rag, and then pull it back and email it back through, something like that. I think the thing is, one of the things that from a VC perspective, I never really got from decks was like just how good the founder was. And I think if it was someone, you know, who was super interesting, they had an interesting background, I often didn't really care what they were building. I cared a lot about the market and where the business was, because, you know, we have LP restrictions on that. But in terms of, you know, we never said, oh, we don't do health, or we don't do this. Like, it was like, okay, well, is this a good person? We should back them. I mean, that's seed investing, right? Do I think that AI in the sourcing and the screening is going to make the whole process of finding and getting connected to investors worse? Yes, 100%. I think it will, because I think it will become really gamified, and it will be and great people will slip through the cracks, and those businesses won't raise, but they might continue to go and build, and that's a loss from a VC perspective. But I think for founders, it's a huge plus. So looking on it like that. But again, it's an interesting topic to think about.
Yeah. We've got loads more questions, so I know everybody wants to get thorough answers, but we'll try and get through them as quickly as possible so everyone gets questions answered in 25 minutes or so. So the next one is Tom.
Yeah, hey Sam.
Hey, Tom.
My question was about venture debt. So for context, we're early stage, we're just raising our pre-seed. And one thing we've considered is raising part of that via venture debt. I'm curious how you would have looked at that as a seed investor, because it seems like on the surface, it's been suggested to us and it seems like a good kind of way to avoid too much dilution, but I'm worried about whether it's seed, they're going to be like, well, you're kind of asking us to pay for what you've done to this point in paying off the debt.
Yeah, I mean, they could stipulate though that the cash doesn't get used for that, and that you just keep the loan there. That it's not common, because a company at between pre-seed and seed, or around pre-seed and seed, taking venture debt is a little uncommon. And the only reason I say that is because often by that point, I mean, so Salica have a venture debt team, again, £100 million fund. The prerequisite for those guys was they needed typically 3 years worth of financials, 3 to 5 years worth of financial data. They would happily lend to loss-making, well, not happily, but they would lend to loss-making businesses on the basis that there would be warrants, and there had to be a huge amount of IP in the business. That was how they kind of securitized that. It depends how much you're thinking about, and also what you're putting the capital to work for. I mean, if you're when we had our business, it was consumer, so it was consumer goods, so it was very easy to kind of lend against. They were like, it's going directly into stock, it's not going into salaries or anything like that. It was just easy to see the cash flow move through. So yeah, is it consumer, or is it sort of like SaaS? Are you thinking about using it for salaries? Like, what's the thoughts?
Yeah, B2B SaaS, it would be to help us hire early on. We wouldn't have to draw it down immediately, but we would give them quite a big warrant. So I think they view it as that they're using venture debt differently. The idea being to get more liquidity, because then at seed they get a big chunk of their money back and just retain the warrant, which seems to make sense to me. But
it makes sense. I just think a new investor would stipulate that the money doesn't go to servicing it would go to servicing the loan, but you're not going to pay back the principal, right? You're just gonna go it's just going to go into just general cash flow. It's an interesting question. I mean, it sounds like you've got a lender already lined up. So is that the case? Yeah. Okay. Yeah. Cool. I mean, I haven't heard of anyone going that early. There's one, I won't name names, but there's one person I think, or one funder I think might be. But yeah, I think if you have it there and you can do it, and it's not personally guaranteed, then why not?
Yeah, okay. It's just whether it avoids. It's like, I know sometimes it's a bit box ticky in early stage investment. So just does that complexity just write us off to some investors a year from now?
No, I wouldn't say so, as long as you can show. In actual fact, it shows probably strong financial behavior, right? It's just whether or not it's whether or not it damages the cap table would be my question. So how their warrants kind of go through, and what that means for you and maybe co-founders, I don't know, or the rest of the team for equity that you have. So I'd think about that. I'd probably model it out in terms of the worst case scenario from a cap table perspective.
Okay, nice, thank you. That's helpful. I might message you after. I'm curious whether your guess is
right.
Right.
Yeah, please do. Just don't do it on LinkedIn. Email me. I'll share my email.
Email, short, sharp email.
There we go. All good, bud.
Thanks, Tom. Andrew.
Thanks so much. Thanks, Sam. And yeah, I was just about to say I'm going to send you a LinkedIn message, but I'll look for that email instead and help you distribute your inbox there. I'm also going to pivot on my question. I put one in the chat that was fairly generic about who to contact at a firm and how, but I think I'm going to pivot to something And also, I think it'd be interesting for everyone about where to draw the line between pre-seed and seed. I've seen some people just say black and white, it's whether you have revenue or not, or sometimes how much revenue. But I'd love to hear your thoughts because my quick scenarios, I'm CEO of a platform for connecting creatives with jobs, B2C, B2B. And it's we have a product up and running. We've got thousands of B2B or B2C users, but we're yet to monetize and raise revenue. And so kind of our scale is more towards seed, but pre-revenues means maybe pre-seed. So just love to hear your thoughts on kind of where do you draw the line and how do you look at that?
Yeah, again, it's a really interesting question, an interesting topic. So we did an analysis about a year ago at Salica and drew the conclusion that the biggest gap in venture funding actually now exists between pre-seed and seed, not seed and Series A. And that was literally a byproduct of the fact that so many pre-seed rounds had been done, and so that like the nature of the businesses or the kind of setup of those businesses at that pre-seed stage was that they had so much to figure out and the failure rate was so high. And I know it sounds obvious, but like, you know, I think now the attitude is very much that, you know, investors want to see somewhat de-risked propositions by seed. Now that could be, you know, first product out, could be waitlist, could be pipeline. Depends if it's, you know, high ACV, you know, really weighted pipeline kind of can come under a lot of scrutiny and there's, you know, sales that are going to kind of come through. Or it's actually just kind of transactions and revenue going through. We at Salica, one of the last, so I didn't take any founder calls for the last month I was there because I just don't think you can bring founders in a process and then leave. It's just not good. But one of the last companies I did kind of see coming through, company that gone from 0 to 15K of MRR in 3 months, but from idea to 15K of MRR in 3 months. It was an AI company, and they were basically skipping pre-seed and going straight to seed and wanting to raise a seed round. But they had been able to just turn on that revenue tap very, very quickly. And that was resonating with seed investors. People were getting quite excited about the company and about the round and what they were up to. Revenue is probably the biggest telltale sign if you're thinking about B2B SaaS or anything in that space. Obviously, for hardware and consumer, it might be slightly different. But yeah, unfortunately, the revenue figure still stands. I can't give you like a black and white, okay, you need to hit this to go and raise X, because, you know, there are always going to be funds that are more excited about your sector, your vertical, the stage you're at and what you're doing. But I do think that that is the biggest gap is pre-seed to seed right now. So it's hard out there, which doesn't answer your question and probably just makes it sound worse. But yeah, I think it is at the moment, that's where the gap exists.
Yeah, nice. Thanks. That is really helpful. Thanks.
Thanks, Andrew. Louise.
Hi, thanks very much for this really useful opportunity. So I put a bit of a cheeky question in the chat at the start, saying how many times is too much to chase an investor. I don't know, I'm kind of feeling like my life is chasing and is it pointless? Does it get to a point where it's rude, etc. But also I wanted to follow up an earlier question about kind of platforms and so on. So when we started our raise, we spent quite a long time getting ourselves on like Deal Room and Razor and UKBAA and Investors and Barclays Demo Directory and whatever. Some of them very painful processes. What I've never been able to work out is, does anyone actually look at those and is there any point? Thanks.
Yeah, good question. I mean, obviously, so I'll start with the first question. So no, I don't think there's never enough in terms of chasing people up. I would just say to change either the medium at which you're doing it over. So, you know, I'm sure there are other people that I've rudely ignored on LinkedIn, but hopefully I'm going to get loads of emails off the back of today and my LinkedIn inbox, I'm like, oh, I have to give up on it, but actually my emails I'm always on top of. So you know, it's about finding that way in and finding, I guess, that pressure point. To the second question, in terms of, sorry, actually, could you repeat the second question as I'm thinking about how I clear my LinkedIn inbox?
Oh dear. Yeah, just about those platforms, you know, the sort of places
Yes, sorry.
you can sort of stick your deck up and hope that somebody looks at it at some point.
Yeah. So the thing with that, right, is that you're the magic in this business, right? It's not a deck, it's often not the product, especially at this early stage. It's you. So you know, it's very hard to get yourself across in front of an investor through those platforms. The UK BAA is, you know, probably one of the largest. The rest of those platforms, some of them I've never been on, some of them I've heard of, but you know, again, I wouldn't say that I've spent a lot of time on them kind of going through decks. Unfortunately, it's a game of trying to get in front of an investor and to actually get them to spend time meeting you and having a call, having a chat. I think the best way to hack distribution right now is actually just through content and through talking about your, you know, your journey, everything you're building, why people should be excited about the opportunity that you've spotted, you know, and doing that on LinkedIn. It's, if you look at some of the founders that are really, you know, really positioned well to raise right now, they have quite large followings and they're doing a lot and sharing a lot of that stuff. I don't think the distribution through those platforms is good enough. And I think what you'll probably find is you're going to get a lot of the wrong attention. So you'll probably get a lot of people who say, oh yeah, we can put you in front of X number of investors. You just got to pay $2,000 to do it, right? You know, loads of stuff like that. Don't ever pay to pitch. It's just a blanket rule. I just can't stand it. Don't ever pay to do that. So yeah, I'm not sure if that's helpful, but I would say I can't say that those platforms give a huge amount of distribution to investors, mainly because it's just not targeted.
Thank you.
Yeah, great, thank you.
Good. James.
Just unmuting. Hi, everyone. Nice to see faces I've seen before, and a pleasure to meet new ones. Purdy, if I shove some really confidential numbers into this chat that I'm happy for everyone here to see, but I don't want broadcast all over YouTube, can you somehow delete it out?
If you post it in the chat won't come up. So as long as you or Sam don't repeat the numbers verbally.
I know, but if I put it on this, if I simply share my screen, is that going to then become?
I can stop the recording, but can I get someone else's question in first, and then I'll go back to you, and then I'll just
yeah, no, fine. Okay, in that case, I won't shove it up. Okay,
just to make it a little bit, yeah.
Yeah, that's fine. Look, I'll just share some numbers that I'm happy. I'll just say it. Well, I'm happy to be in the public domain. Sam, like many, I'm a sort of disappointed by the investment community startup situation. This year is our first full year of trading. Since the 1st of January, my revenue, we've had £210,000 of revenue, of which £90,000 is profit. Why is no one interested in talking to me? Surely I've got something that's good, but I just keep on messing out. It's like silence, it's like speaking to a hole.
So, and this, I'm glad you raised this question, because this just shows the issue that we have right now in venture capital. You've built a strong business that's growing well, right? That's spitting off cash, and investors still don't want to take it seriously. And the reason all comes down, in my opinion, all comes down to how they view size of the prize and size of the outcome, right? So the dynamics here are, if I was to invest in the business, James, from the Salico fund, right? We need to return the fund, right? So we need the investment to be worth 100 million. Let's say hypothetically we take 10% at this round, we get diluted by 20% on the next few rounds, right? We're left with what? Quick maths, you know, 5 to 6%. Right, so the company has to be worth, you know, north of £1 billion for us to then actually kind of return that £100 million in the fund. Most people are looking at it going, do I believe that what James has built and the business, that the space that you're operating in, is it likely that the company is going to get there? That's how investors are thinking. And it's a stupid way of thinking, because I can promise you that 20 to 50 million pounds is a life-changing amount of money, right? For anyone. But unfortunately, as these fund sizes have swelled, and they have swelled because fundamentally, you know, VCs get paid on management fees rather than carry. So they become asset gatherers and they just build AUM. So funds get larger and larger and larger. And it's only going to get worse the more pension fund money comes into the space, right? So, you know, that is why these funds have swelled, and that is why they're at a point where they're looking at the business, James, and they're going, we don't know if this is gonna deliver a big outcome. That is, I promise you, that is probably the sole reason why. Unless you're doing something like you're selling weapons or it's gambling or porn, right? Then but you know, you don't look like an arms dealer, right? You know, so yeah, it's clearly something better than that.
Yeah, okay. In that case, so this starts to ring true with me because the platform it's a marketplace. It's just it's a marketplace sharing space.
Yeah.
And I am absolutely certain that we will be able to hit a revenue of £1 million with massive profit on it. And it's conceivable it could get to 100 or 1,000 times that. I just think it's very unlikely. So in fact, what you're saying is that's the problem. It's just I'm building a very nice small business, and so VC is just not going to touch it. Is that the conclusion?
No, let's not. Don't look at it as a problem. I think it's a huge opportunity, James. I mean, if you're going to walk away with 100% equity and VCs don't get to take some of that, it's just their loss, right? I mean, you know, so it's not a problem. It's a massive opportunity for you. I think it puts you in an annoying position in the short term where, you know, there's no capital to fuel the growth, and it has to be, you know, eat your own dog food and go through. But fundamentally, marketplace businesses are probably one of very few business models that are actually most conducive to venture style returns. The issue is, to get the flywheel going, you either throw huge amounts of capital at it, as we saw with, you know, various startups during 2021, and they just go pop because they build shit that people don't actually need. Or you kind of slog it out. And I can promise you, if you do hit those numbers that you're talking about, when you get to 1 million, when you get to 2 million, you will send me a message on LinkedIn, and hopefully I'll respond this time. And you'll say, such and such Series A investor has just offered me X, because they finally realized that this is a good deal. And all the pre-seed and seed investors will have missed out. Doesn't help you in the here and now, right? And maybe this is more of a motivational pep talk, you know, than anything else. But
it's useful to us. It's just it's good to understand the behavior of the investment community. So it's that's great. Thank you, and thank you to Manoj for your message you've sent me in the chat. I'll look into that right away. Thank you.
Thanks, James. Satish.
Hi, good afternoon. Really enjoying this, by the way. So thank you very much. So my work history is predominantly been in film, television, and radio. So I got fed up of reading horror film scripts, and so I decided to set up a production company. And I'm really after some advice, really. So I've written a business plan. I've developed my my feature film projects as much as I can. And in terms of radio, I've just won a DAB radio license as part of a syndicate. So I think I've got something, but I don't know what to do with that. The advice that I'm getting is, don't go for equity investment right now. Go for business grants, but then I don't know which business grants to go for. And then they say, well, okay, do that first. And no one's going to be interested because no one watches films, which I disagree with, obviously. So I want a bit of advice and a direction, really. I haven't done a pitch deck yet, but I have completed the business plan.
Okay, understood. So, I mean, how much kind of capital are we talking about here?
Well, what I was hoping is, because I've just got the radio license, I'm looking about 150,000 to 250 to build the studios, to get the radio station up and running, because Ofcom only give you a short time to get that going. And then, as far as the feature film projects are concerned, to develop them to final draft so I can take them to investors, and then also spend a bit of time getting distribution companies on board as well, because without a film script, there's no film, and with no film, there's no platform to show that film, then no one's going to do anything, really. So
yeah, I get it. So, I mean, I guess my first question would be, which one comes first in terms of radio and film? You know, clearly you've got great experience in both industries. I don't know what the crossover is. I can't say I have spent much time in radio or film, but I can imagine that actually the focusing on one of the two to start with is probably going to be the best way to execute and get it done. If the 150K is for the studio, I would probably encourage you to try and bootstrap that and be as capital efficient as you possibly can be. So, like, who can you share a studio with? can you do some consultancy work, at the moment within radio? Because clearly you've got, loads of experience, right? And, I know you're only 21, I get that, but like, someone else is someone else is gonna want that experience as well, right? So, I think there's ways that you can start hacking that and trading these things off. I think any time that you raise investment to put it into hardware, I think investors are going to ask big questions about what have you been able to do already? What can you show? Like, are we going from 0 to 50, or are we taking, we're already at 50 because, you've got something live and, it's working, but it's really painful at the moment. And then we go to 60, 70 with this money for the hardware. That's how I would view it.
Okay. Well,
Yeah.
I've just got the license for the West London area. So, so it's an area which covers from Westminster right up to East Berkshire. So an advertising opportunity there, there's sponsorship opportunities. So that can suddenly become more immediate. But then it's kind of go from that to build the studio and then start broadcasting. The minute you start broadcasting and get your first listening figures in, that's the challenge, and hopefully that's the investment. But I mean, would you go for business grants at this stage, or would you try?
For sure. Yeah. Why not? I mean, I 100% would. I mean, we genuinely, we took angel investment on for the cereal bar company. We took about 80K on from angels, and I promise you, we won about £110,000 from various competitions. There was like a FedEx small business grant with this random thing by Huawei. We won loads of money from our uni. Like, there's money out there. It's just finding it and then going through the process, and it can be quite painful. But at the end of the day, it's part of the journey, right? Which doesn't make it easier. But I guess my advice right now would be to focus on one of the two opportunities. I think the radio seems like it's more progressed, and so that seems to make sense. And then I would start, selling the sponsorship opportunities as early as you possibly can. Again, I don't mind sharing this on here, but Forward Pursuit, the media platform that I've just launched with another founder, very serial entrepreneur, we raised all of our sponsorship before we'd even recorded an episode. And it put us under a hell of a lot of pressure to deliver something good. And the sponsors were a bit like, hold on a sec, I thought this was a bit further along. But, we just leveraged some of the stuff we'd already built to try and sell it, and we went from there. Just try and put that stake in the ground.
I'm just going to jump in because we've got another question that I want to try and get through before 3 p.m.
Sorry.
So in 1 minute, if we can, Nick.
Hey, thanks so much, Sam, for your time so far. It's been awesome. Question more on I guess kind of founder energy. So putting your founder hat on, which you are now currently doing. Fundraising, for lots of us who have either kicked off or are looking to kick off fundraising, like, it is an exhausting process. And even like, you've got all the outbound, you've got all that, you've got amazing events, shout out Hotbed, upcoming event, 29th of August, I'm going to apply. Things like that where, we can get our startup in front of lots of investors, but even those kind of take up a lot of energy. How would you kind of best strategize for kind of like getting energy to build up to fundraising? Keeping that energy, particularly if you're not seeing the results that you're hoping for.
Yeah, what a fun question. So firstly, are you sole founder or co-founder?
I'm a sole founder. I got a small team now, which is helping, but
okay. Okay, so I would brief the team on the fact that, if you're the one who's gonna, I guess, commercially deliver on the, the fundraising and the sales side of this, that's gonna be your focus. Some of the best fundraisers I've ever seen have been co-founding teams where only one of the founders focuses on the fundraise, and you drag the other founders in, and you kind of you get a CTO or a COO come in, and they're like, what do you want to know? Well, just quick questions that I want to go back to building, and then you get the CEO there doing the big sales pitch, and it can be hard. It really can be hard. I think you have to get, and this is one thing I've learned kind of coming back out this time, is you have to get energy from the process and not the results, right? So, going along to amazing events, getting to meet other entrepreneurs, refining your idea of what you're building, learning lots, going to sessions where you get to talk shit about investors, all of these things, right? Like they're the things that you need to try and get energy from. it doesn't make it any easier, I promise. Like it really doesn't. But in terms of finding that energy, I think it's about setting those small, clear goals. And some of them, one of the best pieces of advice I've got actually from a founder who her episode hasn't released yet on the podcast, but she said something quite interesting to me, which was she spent a lot of time fundraising, but all of the goals and she actually said that gave her energy with the goals within the business. And she said what she couldn't understand was how the two weren't linked. She was like, the investors are like, we don't really know about this. And she's like, but we've grown another 20% this month, right? The team is grown as well. The team is working really well. Like the product is getting so much more love. Like we're all on this trajectory, you know? So I think you need to take energy from those things because that is fundamentally what you're trying to sell, and the core business and how that progresses. That's what people want. In raising investment it takes too long. Investors take up too much time. But unfortunately, there's a whole industry that's been built off the back of it now, right? You know, like the OGs, the Arthur Rocks, the Doug Leones, like Don Valentine, those guys, like they just did it because they did it on the side and they were just building billion-pound tech companies as well, right? Like it was just fun for them. You know, now it's become too much of an industry that absorbs too much time, in my opinion. So it's a hard one. I would say find yourself a good group of founders as well that you can just be like, you know, fuck, because it is 90% that, right? Unfortunately. Sorry, I don't know if that's helpful or not, but whatever you're doing, just keep going because yeah, we're all in the same boat. I can say that now. We're all in the same boat.
Thanks so much.
There are some questions that we didn't manage to get to in the chat, so apologies if we didn't get around to your question. I would say email Sam, but I don't want to be the person that says that because then I'm just going to make his inbox even fuller.
No, it's all good. Email me any questions you have. If I can help, I help. If not, I can't. I'll do my best, right? I'll do my best to try. If you want intros to, if it's like, oh, okay, I want to be connected to this investor, just tell me who it is at the fund, and if I know them, bang, I promise I'll do it. Yeah, just fire them over. And I hope this has been helpful in some way.
It's been really helpful. Thank you so much, Sam. We will say goodbye to you, let you get on with your day. Founders,
Awesome.
if you have any specific questions about the rest of Hotbed Summer or anything that Em and I can answer, we'll stick around for about 5 minutes. If not, we'll see you at the next session and we'll send around the recording. Thank you.
Amazing. Thank you all.
Bye.
Thanks, guys.